Hey everyone, my name's Andy. My channel is Finding Value. If you like investing in the most undervalued assets in the world with the largest asymmetric bets that I can find, click subscribe and click the thumb up button if you like this content. So I'm going to go over kind of what my portfolio allocation looks like. I'm going to give you the reason why it's this way. Now this is just for me. This is not advice. I'm just saying and stating what I am doing. So this is my investment strategy. And this is kind of what it looks like. I've had a lot of questions around this. So first is the allocation. This is kind of the ideal allocation that I see. And I'm not a financial advisor. I'm not any of those things. A third precious metals, a third real estate, a third stocks. That's kind of where I see the pie right there. Now, real estate, for a lot of people, they need somewhere to live. And in an inflationary environment, and you can buy something or refinance at a 2.75% interest rate or a little bit below that, that seems pretty good because you get to lock in your costs, and if inflation comes, it's going to eat away that 2.75%. And for me, that's what I have, I think. So I'm not paying it off early because the inflation rate is going to be greater than 2.75, which means you're actually paying back to the bank less then you would be paying it off early if your inflation rate is greater than 2.75 or 2.5 or whatever you have. Again, real estate is in cycle and it's going to be increasing quite well in terms of prices. I live in a highly desirable city where real estate prices are appreciating pretty rapidly. So it's a pretty good bet. I'm also in a low tax state with low property taxes in relationship to all the other states. So that's real estate. That is why I have purchased real estate. I own real estate. So that's my reasoning behind it. Next, the other 33% is precious metals. Again, this is of the entire net wealth. With this portion of precious metals, I do ratio investing with this portion. And I showed you a clip of ratio investing and how you can swap between metals and make a very good amount of return. It's the safest area in terms of risk, and you can also grow it. You can grow your ounces over time. So I see that as a no-brainer. In this area, I keep continuing to pile into because you're off the grid. I mean, it's hard to tax. It's all these different things, which are all positive for holding precious metals, physical precious metals. I mainly own platinum and silver. Those are the larger portions. I do own some gold too, don't worry. I own bullion, rounds, bars, government issued coins, 1 ounce, 5 ounce, 10 ounce. I don't hold any 100 ounce of anything because if silver goes to the moon, who's going to buy a 100 ounce bar? I mean, I could do it through a dealer, but I've been able to find 10 ounce bars, 5 ounce bars, 1 ounce bars on sale for insanely cheap prices. The valuation of these two metals, the reason I hold platinum and silver, is because they're insanely cheap. On a historical basis, their ratios against everything else, and I'll show you that, is insanely cheap when I'm buying into these things. And going forward, the demand for them is absolutely insane. You've got fuel cells for platinum. You've got just the regular growth of platinum growing at 5% per year looking backwards. That's without fuel cells. And I'll show you some of that going forward. So going into it, these are ratio charts. This is all platinum right here. So it's platinum to gold, platinum to silver, platinum to palladium, and then the last one is reversed. It's rhodium to platinum because rhodium is usually a more expensive metal. If you look, whenever you get to the far downside or far upsides, it means that that metal is extremely cheap in relationship to history. I went back to 1971, 71, 77, and 72 on these ratio charts. Right now, we're just above 0.5 for a platinum to gold ratio, which hasn't been this cheap. These are averages. This line is an average of this year, average of this year, average of this year. This isn't even getting the huge peaks and bottoms. But I was buying into platinum because of the ratios that you're seeing here. Platinum's extremely cheap, and it hasn't been this cheap all the way back to 1970 against gold. You're getting an absolute steal for platinum against gold. Platinum to silver ratio is still cheap. It's right above 40. Extremely cheap on a historical basis, as it only in the late 70s and early 80s has it been that cheap. Everywhere else it's been more expensive. Platinum to palladium, the ratio hasn't been this cheap ever. It's way down there in cheap land. And rhodium to platinum, look at that, it's off the charts. So I think it was like 16 or something, 16 or 17. Off the charts. So why would I not buy platinum? It is, on a historical basis, never been this cheap. Now, precious metals history. Platinum's cheap to all their metals. Silver was like this in early 2020 during the crash. And in 2018, 2019, silver was an absolute steal, so I was buying that. Rhodium was like this in 2016. Obviously, it's not like that anymore, and I would not be purchasing rhodium. And palladium was like this in 2003 and 2008. So over time, these metals do fluctuate quite a bit against each other, and the opportunities are out there. And all I'm doing is I accumulate and cost average in when the metals are cheap. It's that simple. And how do I know something's expensive or cheap? You just plot it on a chart, and if it's off the chart to the cheap side, then it's cheap. You don't have to have someone tell you what numbers is cheap or expensive. And you can make up when you trade in and when you trade out. I mean, a platinum to gold ratio, if it goes below 1, I would say buy it. And it's way below 1. And if it goes above 2, maybe you sell it and trade it to something else. So this is the platinum demand looking backwards. And this is growing at 4.6% per year from 88 to 2018. And you can see this chart just moving up and up and up. We've got petroleum, medical and biomedical, glass, electrical, chemical, and other uses. It looks like they're all growing. They're all getting larger over time. All of those demand. Now here's primary platinum supply. This, I think, was done in 2018, the year 2018. And they're projecting it to decline throughout time. And that's kind of what we've been doing, is declining. So I don't know if this can really get a huge jolt upward. Maybe it can, I don't know. But if the supply is going to decline and you're growing your other uses outside of fuel cells at 4.6% per year, why would you not take the bet if it's the cheapest it's ever been? We had that Dieselgate scandal, and that's what really drove the market balance into a surplus. But I think investors drove it into a deficit this year. This is the platinum cost curves. I look at that as well. So this is the South African platinum mines cost curves. This is where the 80% of the metals come from. If you notice, these are the mid-tier cost producers, this orangish, yellowish area, and it's around $800 is right here. So their average is about $800. There were opportunities where I was buying platinum under 800. I mean, I don't know how you can lose money if you're buying it below what the producers can produce it at. Eventually, it's going to have to go higher. And this typically is going to be inflationary, so inflation is going to push cost curves higher. The high cost producers are up around 1,200. So that's one thing I look at when I'm looking at purchasing a metal. Is it below its cost curves? Next is the demand for fuel cells. Now, if you go back to this one here, just to make a point, this is 6 million ounces per year. 6 million. They want to use, by 2040, 25 million. That's 4 times the amount just in fuel cells. There's no way we're going to produce that amount, I don't think. There's no way. And by 2030, if fuel cells are going to try to use 12, 13 million, I don't know how they're going to do it. I mean, that's doubling the entire production of today. A complete double. And that's right at 2030. I mean, we're already at 2021. I just see it as, if platinum is going to be used in these quantities, and you're over here and you can buy it against the cheapest it's ever been in history, I don't know why someone wouldn't take that bet. I don't know. And here's some of the forecasts. This is the market balance. So these are deficits, surplus, and then deficit for platinum. Huge deficit in 2020 because investors stepped in. We had COVID, et cetera, and they still are projecting deficits. This is a deficit market. It's going to go way higher. Now, the other third, which is stocks, I like my royalty companies, I'm in diversified mining companies, oil and gas, uranium, silver mining companies. Those are the ones that I kind of gravitate towards because I believe that they're very large, either very large asymmetric bets or they're lower risk, or they track the commodities sector very well overall, like a diversified mining company is. And they've done absolute awesome during the last commodity bull market, and I think they're going to be doing well going forward. So why did I pick these? This is the commodity to 500 S&P 500 ratio. It's just saying commodities are in the dirt, cheaper than they've ever been in 100 years. Why would I not buy that? They are cheap off the charts. Here's another gold to oil ratio. And when the ratio's up here, it just means that oil is never been this cheap. It's never been this cheap. Now it's at 35 right now, and it's been this cheap in history a little bit before, but it's still ungodly cheap. Ungodly cheap. You should be piling into oil, natural gas, uranium, because they are so cheap on a ratio basis in relationship to history, in relationship to any other asset. So you get to buy at the beginning of a commodities bull market the cheapest assets they've ever been in the history. And I think we're rolling into a pretty big commodity bull market. Next, this one is silver to gold ratio. So silver is cheap on the upside, gold is cheap on the low side here. So you'd want to be in gold in the 70s going up, but up here around the 100 ratio, anything over 80, I would say, is an absolute steal for silver. It is absolute steal. And if you notice, we have an uptrend here. When this uptrend breaks to the downside, I think this thing is going to be game on for silver. And here's uranium. Again, we're off the charts in terms of uranium being so cheap in relationship to gold. I think this is going to compress and go all the way down here, given the market balance of uranium. I'm just showing you why I'm purchasing these things, because the ratios are so stinking cheap, and we've got the market balance where the deficits are out in the future of all these materials. So that's why I'm going into them. We have a commodities bull market coming. That changes the rotation of money. That money is going to go into commodities, and it's going to drive these things far higher. Now, I get a lot of questions. What's the most leveraged for this commodity bull market? Uranium and oil, natural gas companies have the most leverage for this upcoming move. I'm sure you've noticed this if you've owned some of these companies, that they are pretty volatile and they move very quickly. The volatility is great when it's going up. Some people don't like it when it's coming down. Silver mining companies also have a lot of leverage to the move. Royalty companies have good leverage with less risk. Silver and platinum physical metals have just good leverage overall. And gold is the standard that we're going and measuring against. So obviously it's not going to be leveraged to itself. But if you're a low risk, have a lot of wealth, I mean, gold, silver, and platinum physically, I think is a really good bet. It's also off the grid. So the conclusion here is, now you know how I value the sectors using ratio analysis. I just showed you a bunch. You also see how I evaluate a potential bottom in platinum by using the cost curves, market balances, and using the valuations. So that's, yeah. And then I also look at the future demand coming out there in terms of fuel cells. Based off this, you know how I structure my portfolio. You know roughly my portfolio allocation. And remember, this is all based off my understanding of commodities and the valuation cycle I think we are in. This is not a recommendation for anyone else. You guys can do whatever you want. I'm not recommending that you follow what I'm doing. I'm just stating what I'm doing because a lot of people ask. Now, I hold a very large portion of physical metals compared to most anyone and probably in the world. And so why do I do that? Because I have a strategy to grow those ounces, and it's very easy. It's super easy. I'm out of the dollar. I'm out of all of these currencies. I don't have to deal with them, messing around with currencies. I don't have to deal with it. I don't want to deal with it. And if I can grow those ounces without taking the risk, why not do it? What are we all trying to go for? Like 100% gains per year? I mean, if I can get 20 or 30% gains a year, I am cool with that, especially if it's off the grid. So that's my portfolio. That's my answer to a lot of your guys' questions. Hopefully, you can do what you want, but that's kind of what I'm reaching forward. going towards to as a 33, 33, 33, a third mix. If you guys like this content, subscribe to the channel, give me a thumbs up, leave comments if you guys have other questions. More than likely, I'll eventually get to them and potentially create a video for it. Thanks for listening. This is Finding Value.